Thank you, all of you. Thank you, the speakers over here. And I'm very excited for this particular panel for various reasons. So on my right, I have somebody who's a risk-taker angel, his views. Then on my left, I have an early-stage focused VC fund. Then next to him, I have views coming in from angel investing in the US. And on the far left, I have somebody who will talk about growth stage. And what I want to cover during this particular presentation is a lot of the angels which have been investing are typically investing deal by deal and are not really thinking through how do you create successful portfolios. And I think the time has come again for angels to look at creating portfolio size investments. Right? And we will try and cover that during our conversation today. So first question to you, Uday. How do you see, as an early stage investor, which founder to bet on, number one? Number two, what thesis on that? And do you have any time points or data points which you look at while investing in at early stage?
Thanks, Nakul. Thank you so much for inviting me here. So I think early stage investing is probably the toughest part of the equation. And as an angel investor, I think we are probably the highest risk takers in the entire value chain. Number one, we put our own money. We're not investing out of a fund. You're putting your own money. You've got really skin in the game. And you're coming in very, very early. My thesis fundamentally is come in early, work with the founder, value add, and make sure you live through the cycle with the founder. The earlier you get in, the better it is. It's high risk, high return, but that goes with the turf. That's what angel investing is all about. You must have a thesis. You must have a portfolio approach. The portfolio also, why you need a portfolio approach? You need two aspects to decide what your portfolio is. One, remember the success ratio for early stage investing is very low. So your ability to hit a jackpot is probably 10, 20% if you're very good. And if you're in that space, then you need to have a large portfolio. So one is you need to have a count. You need to make sure that you do 30, 40 investments. If you don't do 30, 40 investments over a period of time, you have no hope of success. Because if you take a 10% success ratio, if you don't get 3 successes out of 30, you're not going to make money. The second is you have to choose your sectors carefully, because you do a spray and pray, it's not going to work. You have to bet on a few sectors. You might do 2 or 3 sectors, but go deep into it so that multiple use cases are taken care in that space. And therefore you understand what the founder needs. Between companies in the same space, you are able to collaborate and help each one. And you become better and better as you go forward. So I think that for me is important. And for other angel investors here, it's an important thing. Make sure you select a couple of categories or sections, segments, and come in early. Make sure you have enough numbers so that your success ratio comes through. The other part is, when do you get out? Get out when you're not needed. Most angel investors stop adding value after Series B. That's the best time to get out, because after that you're a burden. Rotate your money and put it in somewhere else.
And how do you choose good startups?
Founders. Dekho, at very early in life, there is nothing. There's an Excel sheet and there's a PowerPoint presentation and there's a founder. So you trust the founder. You look at why do you think he has a chance of winning. I think every founder, the thing you need to ask him is, why do you think you have a better chance than 4 other people attempting to win? And it's not about product mode. I think it's a lot to do with the founder mode. And if you can put your finger on it and say, he probably has a better chance of winning, go back him. After that, a lot of it which category, which segment, how much money does he need to really make it successful, and all of those things. Those are other criteria, but I give very high weightage to caliber of the founder and his ability to be, withstanding that tough 4 or 5 years that he has to live through it. Most founders who've been very long in corporate life and want to do this and say, मैंने बहुत successful रहा हूँ corporate में, अब मैं ये कोशिश करता हूँ. I think they don't understand how tough entrepreneurship is. They don't understand how many challenges they will face. So you always try and look for somebody who's already done this before. Because he's been through it earlier. He's seen, he stood in front of, he's been at speed breaker. He stood in front of gate crashes. He's been thrown out of VC meetings. He's seen all of that. Because he's seen all of that, I think it's better to support somebody like that. But for me, that is the criteria number one.
Sure. Vishesh, as an early stage fund, do you look at early stage founder the same way?
Yes, I think.
And how do you choose company?
I think I'll build upon what Uday said. So specific to us, of course, we put some of our money, more than our skin is often in the game, but we also take other people's money, right? And hence, it's important to present a thesis or a broader canvas of what you do and why you do and how you do what you do. Specific to us, we've gone out to say that we're a deep science and tech fund. We largely focus on opportunities that are either university spinouts or, tech industry spinouts, and those are sort of the founders we back. And if you were to peel that further, then, when we go a level deeper into what founder mode means. In most of our cases, you're essentially trying to see if the founders have insights about a certain industry, a certain product, or a strong domain understanding of a certain stream of technology, which most others don't, and they have, and inherently this insight or knowledge is their competitive advantage. And this hopefully allows them to go build a tech mode that later builds into a business mode.
Interesting. Anirudh, how does a growth stage VC look at portfolio construction, look at founder? Is it the same metrics that these two people look at?
Yeah, I think when it comes to growth stage, so our minimum check is $10 million, for instance. So our lens will be a little bit different. We obviously do a lot more quantitative analysis, but just in terms of portfolio construction, it's really about making sure that one, we are thematic. We don't be reactive. That just because an interesting investment opportunity has come our way, we say, oh, this is a great cap table. Lots of people chasing it. Let's go and figure out this company. We like to have a point of view on different sectors. And when I say different sectors, again over there, our filter is really what is important to the Indian economy. For instance, agri is important, logistics is important, pharma, education, healthcare. So we try and do a deep dive on each of these sectors. We have been doing that. And so that's how we work, that we will form a point of view on each of these different sectors, figure out which are the subsegments we like, which are the, what kind of margin profiles, what is the working capital cycle like, things like that. And then we try and take an informed view that this is a sector which is actually suited to tech. There are many sectors today where, if you look in the past 2 years, many companies got funded at crazy valuations, like we all know. And now when those guys come to raise, their subsequent rounds, and we do a double click and look under the hood, there really isn't any tech. They're mostly trading companies. So some of those sectors, as I said, are just not suited. For instance, many, supply chain companies in the FMCG space, in the agri space, these systems are hundreds of years old, right? So the offline traditional infrastructure is already very efficient. So then it doesn't make any sense to disrupt it, quote unquote disrupt it by tech for the sake of it. So then what is the model which is best suited to it? And if there isn't any, then we will not invest. But the idea really is to understand every sector in a very bottoms up way, and then make sure that you have a reasonably diversified exposure and not just be concentrated on one thing. And definitely not follow market trends and market momentum and things like that.
Sure. So, Soumitra, coming to you, how is the early stage investing in the US? And if he can have his slides up also, that'll be helpful.
Yeah, so my thesis is actually a reflection of my own journey. It's been an interesting journey. I was a venture investor in India, and right in the early stages when mobile internet was just starting up here, moved to the Bay Area, drove expansion for Alibaba Group, did my own startup, 0 to 1. So I've been pretty much all around the table. And really in this journey of operating, building, investing, executing in multiple geos across the world, I've come to this worldview that in the next 20 years, India is going to be a key supplier of entrepreneurial talent for the world. If you look at the Western countries, most Western countries have negative demographics. So today with AI, and I think everyone sort of understands innovation, and for any country to maintain its competitiveness, really having talent to be able to drive that is key. Even if you look at what, and this has actually been a surprising part, look at Middle East or Southeast Asia, there it's actually a skill gap, right? Where the local entrepreneurial talent just does not have the skill set or a combination of technical skills and the entrepreneurial hustle. So that's really my kind of worldview that I have iterated on over many years and really arrived at. And so my focus area, to answer your question, is really what I focus on is the global Indian founder, which is essentially 2 buckets. So it's founders in India building for the world. And we obviously hear a lot about the US-India corridor and the SaaS corridor and enterprise software. But I think, Vishesh, you would sort of, I think you are at the forefront of it. A lot of deep tech work is happening, right? And that's sort of the cutting edge innovation. The second bucket within that is actually immigrant founders in the US and in sort of other countries as well, right? And I think there has been, of course, a movement in the last 10, 20 years where sort of Indians moved to the US or Europe for studies and then sort of worked there and then started companies and now are holding key executive positions. I think we are going to see that really happening at an exponential pace and sort of new models are going to evolve, right? So that's sort of my overall thesis and worldview. I think in terms of, I think there are 2 pillars of any investing strategy that I look at, and really to summarize it very, very simply, right? There is a founder and then there is market. I think on the founder side, and now having invested in everything from Paytm to idea stage company, one of my kind of key learnings has been that the number 1 leading indicator of success is actually grit. Nothing else matters, right? And I mean, I've seen that as an investor in Shanti's journey as well. And now I think I look at companies that I invested in 2014 as an angel, and the founders that are still standing are now getting massive compounding in the end. So, of course, the actual, I mean, when you're kind of meeting founders, you're looking for various aspects, domain expertise and all that. But to me, I think a leading signal where I sort of sit up and take notice is when I see signals of grit. On the market side, I have this word that I sort of use often, which is I get excited by non-incremental startups, right? And it's quite hard to, again, define. But the way I look at it is that are you building a business that is unique, that is very hard for anybody else to build, right? And for me, a heuristic is, can 2 kids out of YC build this tomorrow, right? And that's actually the YC model, right? So we have actually come to a place where I think, Anirudh, to your point, like technology is baseline. It's table stakes. Any product can be built by a couple of developers anywhere, and now with AI, I mean, it's getting sort of even easier, right? So how do you build moats and how do you build differentiation, which then ultimately actually translates to a business model that has pricing power, that actually becomes profitable, where the founders dilute less, all the good things that you want in a sustainable, long-term, profitable, growing business. It actually starts from, hey, what is your competitive advantage, right? That's what I'm netted out to. So literally, I look for gritty founders building non-incremental startups. That's my kind of thesis.
In your last slide, you had something about portfolio construction. Could you talk about that?
Yeah, so portfolio construction, again, I think very simply, there are 3 ideas that I want to leave all angels and I think even VCs with. I think one is that you need to have a strategy. The beauty of venture capital is that a lot of strategies can work, right? So you have the Moneyball strategy that YC and 500 startups have followed. You can be actually sector focused. So you can, if you understand healthcare really well, just do health tech. There are people who have a founder first strategy, which is, hey, I'll just index on the founder. I don't care about the market, right? So that's the beauty, but you have to choose one strategy and stick to it. I think the second idea is take enough shots at the goal. So there's a very interesting study that was done by Horsley Bridge, which is one of the top institutional LPs globally. They looked at the vintages of absolute top tier funds like Sequoia, Benchmark, right? So the global Silicon Valley funds from inception. So it's like decades of data. And it was a very interesting insight that came out of that. Only about 4.5% of all their portfolio companies actually gave them all their returns, right? So think about it. A Sequoia or a Benchmark, which are the OGs of venture capital, their picking ability is 4.5%, right? So I'm sure you and I are probably going to be probably 50% of that, right, if you're lucky. So you need to have enough shots at the goal so that power law works for you, right? It's a massively power law driven industry. So I think that's sort of the second idea, which is take enough shots at the goal. And I think third is you need to be extremely patient. I know that you mentioned kind of the exit part. I actually disagree with that. I feel that power law is so brutal and winners get created so infrequently and it's so tough that once you get a winner, you better ride it. And you ride it to the end, right? So, of course, there are situations where, especially as small angels, there's a cap table cleanup that happens and you are kind of in the larger interest forced to exit. That's a different situation. But in most cases, once a business gets PMF, you better stick to that PMF. It's very hard to get, right? So that's again my learning. So most compounding of returns happens post the 10-year mark. So I would say as an angel, you should be prepared for about a 10 to 15-year hold period in your winners, right? So that would be my third idea, which is be patient.
And I'm just going to build upon this whole power law point. It's a very interesting one. So there are two sides to it. One is you want to make sure you're taking enough shots at the goal. But the other part is once you know that this 4.5-5% hit rate is working in your favor, you want to put more money to work on that, right? Because when the needle moves, it needs to make sure it just moves the whole clock and not just that 1 minute. And I think, of course, as a fund, we think about it more consciously to make sure that you leave aside more money to double down on what looks like a winner so that when it moves in a big way and takes care of the larger portfolio. Is that something you actively look at as an angel investor as well?
Yeah, and that's why I again have I don't know if it's controversial or not, I feel that entry price matters a lot. You can see it in portfolios and investing in a company at a 20 million valuation versus at a 4 to 5 million valuation, trust me, it looks not that different on an Excel sheet. Eventually, it matters a lot. So
yeah, I think that's the real delta. Yeah. And the compounding makes so much of a difference. However, I think there's a slight difference of being an angel, early stage fund versus being an angel investor. And I think that's where a lot of cleanup happens at some point in time of the cap table. So, going back to your point of saying, yes, at some point in time, angel investors will get cleaned up. But if the angel investors got in early, instead of 20 million, got in at 4 million, then you really made the money in the bargain. In that, I'm assuming that at 30, 40 million is when Series B happens. You've got that journey, which is maybe a 15x or a 20x or whatever that number is. So if you can get that and you can have enough number of shots at the goal, I think that can give you far better returns than most public markets can give.
So Anirudh, do you also look at getting enough shots in the goal? How do you structure your thesis and portfolio?
I was just going to make a comment on both the power law and the exit bit. The one thing I caution myself against, my colleagues in our firm, and I firmly believe this, power law, the theory of power law has the ability to make people lazy. So power law doesn't mean you just spray and pray and let's just take 100 shots on goal and see which one hit, which one sticks. I think power law works if you have intelligently invested in all 100 of those. So it's very important to still do the work and not just say that I want to invest in as many companies as possible. So as long as one is doing that, I think the power law aspect works out. But it should not be, one shouldn't think that just because I've invested in a lot of companies, something will work out. I think that analysis or whatever evaluation one does, even as an angel, that should happen for every investment. And then you should go on and obviously have a larger portfolio than a smaller portfolio. And also on the exits bit, I actually think that one has to sell out at some point. Warren Buffett's mentor, whose name I keep forgetting, made a very interesting observation, which I think is true, that you will always make an error when you're selling. You can never sell perfect. You can never have a perfect exit. Either the thing will go up after you've sold, or it will go down and you'll feel lucky. But the point is, one should, as a fund manager, even I think that my expertise lasts up to a point. For instance, when a company has gone public, do I still keep holding on to a stock? I don't think I should be making that call. It's not I don't know what will drive that stock. It certainly won't just be the fundamentals. If it was that, then stock picking would be a lot easier. So I will never hold on to a stock, even though I think it can go up 5x, 7x, 10x, and it very well might. But my job is to understand that my expertise lies till this point, and if I have hit my threshold return, or hopefully higher than that, then I should sell. And I see this mistake being made. I have made this mistake in the past. I've seen this mistake being made by a lot of funds, angels, where they keep holding on to their investments, thinking that this will go up, 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 but it doesn't really happen. I'll give you an example. There was this one company where a particular fund sold part of their position, a meaningful part of their position at $1 billion or $1.4 billion, and then the other co-investor was asked, do you also want to sell? There was a lot of demand for that stock. And the co-investor said, no, I'm going to wait for this to go to 10 billion. Why? Why will this go to 10 billion? How many $10 billion companies exist in India today? So what was the basis of saying this will go from 1 to 10? Nothing. So it's very important to know when to sell, not necessarily just looking at, I do agree with Soumitra's point on compounding. It does come late in the day, but it's also important to recognize where does one's expertise end. And so do you want to take the unnecessary risk beyond your threshold return? I think that's from an exit, and from an exit perspective, it's very important for us at least to keep that in mind.
So one point I wanted to add on the power law bit, and I think it's important for people who want to be angels. The logic of power law also makes sure that you allocate enough money for being an angel investor. The problem is that people come in and say, I made 4 investments and now I'm an angel investor. You've literally written off that money. Because if you made 4 investments, total 4 investments, and you have, a 4.5% strike rate, you can be rest assured you lost the money. So if you're really wanting to seriously look at angel investment and you have a runway of a few years, you want to make sure you have enough so that the 4.5% kicks in. I mean, hopefully you'll be luckier in a market like India where there are more, better returns coming in right now. But I'm just saying that give yourself a chance by doing 2 angel investments or 3 angel investments, saying, I'm going to have a very concentrated portfolio. It doesn't work because you will only have that much success.
So this is interesting. I think all of you are saying, talking about is power law, investing in companies, being able to exit, betting early on the founders. Vishesh, I want to come to you. Keeping all this in mind, what is a Bichara angel supposed to do? And we're talking about making a lot more investments. You at an early stage fund, what is your thesis in terms of 10 companies, 20 companies, 30 companies? How do you, in the boom time, there were so many startups to invest into. What 3 things will you tell the investors over here to manage the power law, right? And some parameters when to exit.
So I don't think there's a right answer. Different things work for different people. A firm like us, we do about 20 investments, invest across 4 or 5 years. We're quite disciplined about making sure we invest across a certain period of time because it sort of diversifies yourself for currency risk, political risk, macro risks. One, it also gives you a fair shot in making sure you're seeing different kinds of trends, right? We end up seeing about 1,800, 2,000 companies a year. We pick 4 or 5 of them. So the other part of making sure your investors see enough, say no enough times to make sure what you really want to do. Third aspect to the power law is, and there's a statement out there that says, top 1 or 2 companies drive all returns. Ensure that when you win big. the win big is important. So the way we think about winning big is we want to make sure we put more money in the ones that do well. So as a fund, when you win, you end up winning a lot more on the ones you win, and you will lose, you want to end up losing a lot less. So a firm like us thinks out of 20 companies, we'll have about 5 of them that does really well. You want to make sure from a dollar allocation standpoint, you have half the money in them at least.
So if I'm hearing you, what you're saying, 20 to 30 companies, probably 1/4 double downing on those companies and looking at creating a portfolio around that. Any views by any of the panelists? 3 things you like to tell the angels over here, different or similar to what we're talking about?
So I would step back and say, in public markets, we all do a SIP. So, that's the best form of investment. You're making sure you're evening out any cycle that you're going through. Mentally, you have to have the discipline of saying, irrespective of the cycle, irrespective of whatever, I'm going to continue to invest over a period of time, and I'm not going to do more or less. 9 out of 10 times, remember, you have to say no. So you have to have very strong reasons to say yes. If you don't have strong reasons and it's just the noise around you which is making you say yes, I think you're falling into the same trap that public markets will fall into. So public markets, what happened? Most people buy at peaks and sell when everything is down. You'll end up doing exactly the same thing in private markets. So treat it more like a SIP and say, I will invest continuously at a pace, make sure I say more no's than yes, and do it with a discipline, making sure the sector's there, making sure you have enough shorts at the goal, or you have enough of a wide portfolio. Otherwise, you're really setting up yourself for failure.
Soumitra, Anirudh, last comments?
Yeah, I think there's one thing that's common to any investing in any asset class, right? You look at public markets, look at Warren Buffett, Charlie Munger, look at real asset investing, Brookfield, best venture investors, right? You need to know what your edge is, right? Like you need to know what you understand. Where is it that you have an edge? What's your, Warren Buffett calls it circle of competence. It can be very narrow, by the way. I mean, I know of people who basically only invest in Googlers. They're like, look, I'm just going to I just get the best founders coming out of Google. There are people who just invest in not even IIT, like IIT Bombay alumni. And they've actually made excellent returns, right, through that. So it can be a very narrow competence area as well. But you just need to know it very well, so there's no adverse selection. You just get access to the best founders working on the most interesting problems, right? So I think one thing I would want especially angels, to take away from this session is, I think, spending the time to figure out your edge, right? And that's super important, I think.
I think for me, the most profound question in investing, in private investing, be it as an angel or as an institution, is how to evaluate a founder. And I don't think that question will ever have a clear answer. But whatever I have, for me, the 2-3 most important things, I think one which Soumitra mentioned, grit. I think persistence is the only uniform trait you'll find among all successful founders. The second one is having the clarity of thought. And some of the best investments which I have been a part of, almost in all of them, it was a very simple vision which the founder had. For instance, in Swiggy, Harsha's back in 2014, when he had just started the company, his vision was, I am creating a layer of dominoes on top of every restaurant. That's it. It's as simple as that. And he hasn't wavered from that. And then the third thing is having that kind of vision, knowing what you're building in the long term, but also having the short-term execution capability, being able to be the janitor if you need to be, doing whatever it takes to make your business work in the short and medium term. I think to me, those are my learnings as an investor. And I don't think those qualities change even when you're looking at a company in the public, listed space. They remain as important. And I'm sure there's many more qualities which are.
Sure, thanks. I think we're just out of time. Just to summarize, I think a lot of the panelists are talking about the founder, the ability, the vision, the ability of the founder to execute, coupled with the fact that creating a portfolio of 20-30 companies, 25% doubling down on, having an exit strategy. And all these components lose parameters. It will change from people to people, but I think that's what the panelists over here are saying. And so we'll end with that. Obviously, this is a much longer conversation and can go on, and the panelists will be over here as well. So it'll be great for you angels to meet them up as well. Thank you so much.
I have a question for the panel. And this is a little bit of a controversial question, so I wanted to put it out. You know, here in this panel, we have a combination of fund managers, syndicates, and individual angels. But just from all of your observation, what is the bad behavior you're seeing in syndicate managers, right? Because when you listen to this panel, you almost feel like as an angel investor, you should know exactly everything where you need to put money. And that's not the reality, and that's not the ground reality. People have capital, they are still discovering this asset class, and they rely on syndicate managers. But if you look at Vishesh and the way he described a fund manager's role, is that you have a fiduciary responsibility to your LPs. So just from all of your experience, do you think that syndicate leads feel the same fiduciary responsibility to their backers? And where do you see bad behavior in the ecosystem? I would love to hear that.
I think my experience, and I've led quite a few syndicates, I think the core thing that I look at is there a conflict of interest in the syndicate lead versus the company? Is the syndicate lead in some way involved in the company? Or is he clearly representing the group of investors? And I think fundamentally, as a syndicate lead, you are representing the group of investors and on their behalf investing. If there is something happening between the company and the syndicate lead, I think that's a red flag. I've seen all sorts of stuff happen, but you know, that I think for me personally is an ethical problem and should not exist. You have to make sure that you are standing firm for the group of people who are investing.
I mean, I honestly don't know enough, so it's hard to comment, but I think the learning I have is, I think investing is, the point of entry of investing is too overrated. It's just one of the three aspects of what you do, right? It'll be good to see if the syndicate leads are able to carry on understanding of the company's performance and information. And I, speaking for myself personally, believe that insight is what allows you to think a little bit more about, you know, do you put more money to use? Do you come out? Or what do you learn from there to find something else? This whole point of entry is so overrated that sometimes less effort time goes into the, you know, how do you get out, how do you consume information on the company's performance to come out? I know it's not easy. I don't think founders are going to give information to everybody, but I think it'll be useful to make sure that that cycle sort of goes through as well.
Soumitra would like to answer Shanti as well.
Yeah, I have not experienced too much of bad behavior myself, but I think some things I've observed in general, especially in some of the informal kind of angel groups or networks, is there is a lack of a balanced view on companies or deals represented. So I always feel that there should be kind of a very rigorous view on the company, right, which should be balanced. I think that's, so I think just sort of ensuring that just builds trust with people sort of who are putting money behind you. That would be kind of my only, that's something that kind of has irked me on a few times, yeah.
I think from my end, firstly, I should say that some of the most amazing companies which I have seen and I've been fortunate to be a part of are there because of angels and syndicates, because oftentimes they are able to take a view, a contrarian view, which the rest of the market is not able to take. And as a result, you know, they save those companies in really bad times. So that's something which I should, you know, put it out there. But I think I haven't experienced too much of this very bad behavior as such, but I think a couple of things, or one big observation I had is in 2 or 3 cases actually, the same thing, that many times an angel or a syndicate will be a Monday morning quarterback. Basically, they'll promise something to the founder. In fact, this is an actual thing which happened where we gave a term sheet to a company and another tier 1 fund signed up with us. And this was a series A or whatever, the first institutional round. And then suddenly the angel shows up and says, hey, I sent you a WhatsApp message committing my 500K in this or whatever that amount was in this company. But there was no term sheet, there was nothing. That angel was just waiting for a VC to show up, and then when the VC comes in, then I'll, actually make it official. And so so that's not real commitment. And the founder was in a dilemma that, hey, I've already, this person already committed to me, I feel bad, this, that. And so I had to tell this, founder that, listen, and this happened 2 times, by the way, with the same person, right? So the second time I was very clear. I said, see, I know this person's strategy. He's not really making a commitment to you. He's just trying to wait it out and see if you get other VCs. And then if someone else shows up, does a $2 million round, sure, I'll give you 500K. But the conviction should be there on day 1, right? You should send the term sheet. If you really like the founder, the company, then you should be the first one there planting the flag. And the founder should be able to use your name and say that, hey, this person's already committed. And so I want others to come in. So that I feel is unfair to the founder. And I don't think that should happen. And to be fair, I haven't seen it too many times. But, since Shanti, you asked, so I mentioned this.
Thank you so much, panelists.